What is up, guys? Welcome back to the channel. Today we're going to be going over how to calculate materiality, understanding key concepts of materiality, performance materiality, and the trivial threshold in the context of an audit. My name is Bryan Carreto. I'm a CPA, and I'm here to help simplify all things accounting related for you. So let's get straight into it. All right, so as far as materiality goes, and I'm going to go over the definition, how to measure it typically, and the time frame of when you should be calculating this. So for materiality, to the definition, I'm going to read straight from the slide here. Materiality is the largest amount of misstatement that you believe would influence the decisions of someone using the financial statement. So essentially, it determines what is important and what's not important. Again, and then as far as measurement goes, it's typically expressed as a percentage of total revenue, total assets, net income, depending on the relevant benchmark. When we get into the actual live presentation, when I actually walk you through how to actually calculate materiality, I'll kind of show you guys how to calculate it, how to determine what's a relevant benchmark. Essentially, it's what's the most important benchmark to the users of the financial statements, and that's going to help drive what your materiality is going to be. Again, typically, I just want to make sure you get this point across. It's expressed as a percentage of a total relevant benchmark, and that benchmark typically, in my experience, has been revenue because, as you all know, revenue drives how much net income a company has, how much money they're going to be making, how much growth they're going to experience through the coming years, and that typically is going to be a reflector or a benchmark of how the company's doing, and that's going to dictate the users of the financial statements, which can be management, investors, third parties, banks, they have a debt covenant with the bank. So that's going to determine who uses the financials. And again, so I just want to make sure you guys understand that it's typically expressed as a percentage of a relevant benchmark. And that benchmark typically, in my experience, has been revenue, but depending on if you audit like banks or other things like that, it could be, another benchmark. So just keep that in mind. As far as time frame goes, it's usually assessed during the initial planning phases of an audit. Okay, now performance materiality. So performance materiality is the amount set below overall materiality to reduce the risk that total uncorrected misstatements exceed the overall, sorry about that. It should be that do not exceed, to reduce the total uncorrected misstatements that do not exceed overall materiality. So performance materiality is usually an amount set below overall materiality, and as far as a measurement goes, it's usually a percentage of materiality, usually between 70 to 80% of your overall materiality. So essentially, once you calculate your materiality, you calculate what's your relevant benchmark, your percentage or whatever you're going to use of that benchmark, then your performance materiality is set one level below that. And typically, in my experience, in my professional career, it's between 70 and 80% of your overall materiality. And typically, your performance materiality, you're going to use this for your sampling, for your testing. You're going to make sample selections of this. Again, it's just an amount set below your overall materiality to reduce the risk that the total uncorrected misstatements do not exceed the overall materiality. Cool. And then time frame, also it's assessed during the initial planning phases of the audit. So typically you can't really start doing much of your audit until you have your materiality calculated, because how are you going to know what's important, what's not? What are you supposed to scope in? What can you leave out? So just keep that in mind. Okay, the trivial threshold, my favorite number in all of audit, is essentially what is immaterial. But let's go read the definition. So the definition is the threshold below which misstatements are considered trivial or immaterial. Essentially, if you have a difference that's below this trivial amount, then it's considered immaterial. You don't have to look into it. You don't need to document further. If you have a difference, you can literally say, hey, my difference, whether it's a reconciliation difference, if you extrapolate an amount in your testing and your total misstatement falls below your trivial threshold, you can literally move on. You can literally say, hey, the total misstatement is below my trivial threshold. The auditor will pass on further work or whatever the case may be. So again, and as far as measurement goes, it's calculated, in my professional experience, it's usually between 3 to 5% of your overall materiality. And it's defined as an amount deemed immaterial and not requiring adjustment. Again, you can literally have a difference in your sample selection, in a reconciliation, in your testing. That's a difference, but as long as it's below this trivial threshold, you don't need to do anything over it. And as far as time frame goes, it's assessed during the initial planning phases of the audit. So I hope I was able to really bring that home for you as far as time frame, because again, you can't determine what you're going to test. You can't determine what you're going to be doing until you figure out essentially what your materiality is. So from your materiality, you calculate performance materiality, then your clearly trivial threshold, your immaterial threshold. Essentially, that determines, so again, just a quick summary, material. If something's material, then it needs to be scoped in the audit. Performance materiality, that's a percentage, that's a number, that's the number below materiality that's set as a percentage of your total materiality, typically between 70 and 80%, and then your trivial threshold is usually between 3 to 5% of your overall materiality number, and that determines whether you need to look into a number, whether a difference is going to be determined if you need to make an audit adjustment, a pass adjustment, whatever the case may be. So, all right, let's get into an actual client example, and then let's hopefully illustrate this for you guys a little bit more in depth, and then that'll hopefully bring it all home for you guys. So let's go through, let's bring up our Excel. All right, okay, so now we got our Excel here, and we're gonna go through this. So we're gonna make that a little bigger. Let's make that a little smaller. Okay, cool. All right, so as far as, as you guys know, as you guys are going through this audit course, we always make sure our work papers are as aesthetic as possible. So you always wanna make sure that you name your work papers. So the first thing, CPA firm LLC, that's gonna be the firm name or the company name. And then materiality form. So we always want to name our work papers, right? You want someone that's going to be reviewing this. You want them to know exactly what you're going to be working on and what this work paper is all about. So this is a materiality form. And our period end is going to be 12/31/2025. And as always, we always got to add some type of note or some purpose to the work paper to, again, let the reviewer know, whoever's going to be reviewing this, what exactly we're going to be doing in this work paper. So in this work paper, the purpose of this work paper is to document materiality, performance materiality, and the trivial threshold. That's exactly what we're going to be doing. And for our key financial figures, and typically in your planning process, you should be able to pull a lot of these figures. And again, I'll go through the key inputs in my professional experience that I've seen throughout my whole career that helps you determine how you can calculate materiality for your audit when you're going through it. Okay, so as far as key financial figures go, so the private retail company, it's CPA Swag LLC. You know what? I'm going to Control C and Control V on here because, again, it should typically be the company that you're auditing, whatever form it's going to be, the form name or whatever you're working on, and then the period end date that you're auditing. So in our example, this is for the period ending 12/31/2025. So it's for the audit year 2025. Okay, so continuing on. So as we go here, we looked at, okay, so our key financial figures in here are going to be revenue, net income, and total assets. And as you guys can see here, if you do control open bracket, you will go to exactly where that number is coming from. So here, you can see here, essentially that is, oh, I don't want to hit F2 again. Okay, that is essentially control open bracket. It's just your total revenue. You guys can see that? So 14.8, I'm going to make this a little bigger here. So 14.8, so 14.7 is essentially the total revenue that we're calculating for the company. And again, you guys can see here, it's just coming from the trial balance. So you can get all these numbers from the trial balance. Whatever audit software you're using, just be able to make sure you can back up your number. You can validate that the number you're using is actually accurate. So going back to our example, so total revenue, same thing for net income. That's coming from the trial balance, control open bracket again. That's coming from here. And then as the reviewer, you can see, okay, how's my team calculating this? Are they calculating this correctly? So net income for the company is 3.4 million. Going back here. And then total assets is also a key financial figure. So again, control open left bracket. There, we go straight to where that number is coming from. We go here, let's check. All right, back to what we were saying. So we want to make sure we get the total assets in here. So that is 19.6 million. Okay, beautiful. Okay, and that's calculated essentially total assets. So as a reviewer, again, I want to make sure that the numbers my team is coming up with are actually accurate and they agree to our trial balance. So going back here, so total assets. All right, so now we have our key financial figures. These are our what we call our relevant benchmarks, but we need to determine, are we going to use total revenue to calculate materiality, net income, total assets? We need to substantiate the number that we're going to use and why we're using that particular number. Okay? All right, so continuing on. So company name. So I really want you guys to download this template so you guys can see and you guys can figure out. And again, no matter what firm you're at or where you're going to be working, this is pretty standard. And based on my experience, a lot of firms, I mean, typically you'll have these inputs in your work paper on how you're going to substantiate how you're calculating materiality. Does it get a little bit more complicated? Sure, but as long as you understand these key concepts, you should be okay. All right, so as far as company name goes, so the company name is CPA Swag LLC. They sell CPA Swag t-shirts. Cool. So we put that there. Primary users of the financial statements. So this is where, and then as far as notes go, you guys can see here like what the notes are, what I added here. So the primary users of the financials, essentially when that question is asking you is like, the reason we're auditing this company is for a reason, right? Maybe they have a bank debt, maybe they have a bank loan, and they have debt covenants with the bank, so they have to issue audited financials. Maybe they're a publicly traded company and they have to give the SEC their audited financials by a certain date. Maybe management, they don't have a bank loan, they're not a public company, and that they just want to have audited financials for good internal controls, and they want to make sure that the numbers they're reporting each and every month are accurate, or the private equity group that owns them wants them to have numbers even though they have a bank loan. Again, there's a plethora of reasons why, but this is where you as the auditor, you need to understand and make sure that you understand why you're even there. Like, just ask, hey, I mean, I'm hired to do the audit, but like, why do they need an audit? Is it management's decision? Is it a bank loan? Typically, it's three things. Whether it's management's decision internally to get an audit, which sometimes it happens, sometimes it doesn't. For the most part, if it's a private company and they have a bank loan from whether it's Wells Fargo, Chase Bank, whoever it may be, they're going to usually require them to get audited financials because think about it. I mean, the bank's going to require them to meet certain financial metrics to ensure that the bank gets paid back, right? And based on that, the bank wants to make sure that they have audited financials to make sure that their numbers are accurate. Or it's a publicly traded company that's a little bit more complex. But that being said, that's going to help you answer this primary users of the financial statement question. And in our example, CPA Swag LLC, it's a company that's privately owned, but they have bank covenants, as you guys can see from the notes. I'm going to make this a little bigger here. So let's do 130. All right, so the reason, lenders, investors, and internal management, that's the primary users of the financials. So based on the fact that it's lenders, investors, and internal management, but again, we know it's a private company, so it's not publicly traded. And then this is where you can start thinking as a good auditor, right? Like, okay, well, if these are the primary users of the financials, what helps them make decisions? What are the key metrics that the users of the financial statements are going to be using to help them make decisions about the company? And based on that, we look, let's say in our example, we looked at their debt covenants, and a big portion of that is EBITDA. They help make decisions at the end of each year. They base their budgets on their projected revenue number for the year, how much revenue is going to grow year over year. So the fact that revenue is such a big driver in what they do, then it's safe to say that the revenue would be a selected benchmark. But based on this, the primary users of the financials, before we get ahead of ourselves a little bit, the primary users of the financials should be, it's a private company and they have a bank covenants. So I would say management. So management and the lender and the bank. And the bank, we could put in parentheses, lender is Chase Bank. I don't know. It's just an example. Chase Bank. Cool. So again, we know exactly, you know what? Let's make this blue. Just so it's different from, the other colors. Oh, what the heck? Man, why doesn't, all right, let's make this a cool color, blue. There we go. Just so we can see the difference between like what we're documenting and what's in our template already. Okay, so company name, CPA Swag, the primary users of the financials. We know that the only reason they're getting a audit, the only reason we're here to do the job is because they have bank covenants and management also wants them to, have audited financials. So based on that, management and the bank, lender is Chase Bank, is the primary users of the financials. Those are the people that are going to receive our audit report, read it, look through it, and understand what's going on with the company. So as far as selected benchmark goes, again, we kind of talked about it already. What do you guys think would be the selected benchmark? Is it revenue, net income, total assets? I'm going to say revenue because revenue helps the company make key certain financial decisions and helps them drive business decisions for the company. So revenue is going to be the benchmark that helps them determine what decisions they're going to be making and what's something that can also be maybe manipulated or start thinking in these ways, right? So as far as selected benchmark, I'm going to say revenue is going to be our benchmark to calculate what's material and what's not to the financials. Okay, reason for selecting benchmark, revenue. So we're going to say revenue is used as the primary driver to assess the health, or to assess, to make, all right, revenue, all right, let's go back here. Revenue is used as the primary driver to assist management in making business decisions, and the company's bank covenants are driven primarily by revenue. That's it. All right, let's go ahead and merge, wrap, Alt-H-A-L, cool. All right, so even though we selected revenue, right, we need to document why we're selecting revenue. Revenue is used as the primary driver to assist management in making, let's say, key business decisions, and the company's bank covenants are driven primarily by, and the company's bank covenants are driven primarily by revenue. So that's it. And it's as simple as that. You just really need to, all right, let's, we just maybe spell check that, F7, that's all I did. So we just need to make sure, and we need to document why. And documentation is super important. In your audit work papers, documentation is the most important thing. So we substantiated why. Revenue is a primary driver. It helps make key business decisions, and the company meeting their debt covenants are driven primarily by revenue. Revenue is the key driver. So that's it. We're good there. Okay, so now we enter the benchmark amount. So now that we have our key financial figures here, we can literally hit plus, and then we're going to do revenue in here. So we're going to bring that in here. Bam. Awesome. So now we have, okay, so now we have this. All right, so here's what we're going to do. So now we put our revenue number in here. And materiality is going to, again, remember, materiality is just a percentage of your overall benchmark. And in our example here, in our firm, revenue is 10% of whatever benchmark you select. Again, it could be 15%, it could be 5%, whatever the case may be, whatever firm you're at has going to have different methodology. Every firm has their own way of calculating materiality. Back in the day, way back then, I didn't even have to do this when I started. You had to do this by hand, and it was a certain percentage. Now, a lot of firms, especially with AI and everything, they have tools for you to calculate this. So all you really need to do is calculate or document why you chose your primary benchmark. Put your benchmark amount inside your form, and it'll literally spit out your materiality number for you. So, okay, let's go ahead and, you know what? Let's go ahead and remove this formatting from here. So let's do clear rows from selected cells. Awesome. All right, cool. So what we have here now is Alt-HK. Cool. So now we have Alt-H9, Alt-H9. Beautiful. All right. So now we have our materiality. So if we have our materiality, if you guys can see here, is literally 10% of our benchmark. And our benchmark is revenue, and we documented why we chose revenue as our relevant benchmark. Performance materiality. Now, performance materiality, again, is a number set below your overall materiality. So in our example here, it's going to be 80% of ML, or materiality. That's kind of just an abbreviation. Us auditors, accountants, we use abbreviations for everything. So just keep that in mind, okay? So now we have materiality is 80% of your overall materiality. So it's 1.1 million. 1.4, and then you can always round these numbers too. But for our example's sake, we'll keep them. You can always, don't round up, you always round down. Okay, just keep that in mind. Okay, so materiality, again, 10% of your overall materiality. Okay, 10% of your benchmark. That's your overall materiality, or your materiality. Your performance materiality is a derivative of your materiality, which, again, if you see here from the formula, it's 80% of your materiality, okay? So your materiality in our example is 1.4 million. And here it's, and you know what? Let's actually round these numbers, man. Round, okay, let's do -1. Oh, no, let's do -3. Beautiful, okay, cool. So see, it just makes it a little bit more, 1.4 million. No, you know what? For our example, let's just keep it simple. Okay, cool. So performance materiality, 80% of your ML. That's essentially, again, it's just a number set below your materiality. So it could be 75%, could be 70%, could be 80%, 85%. You're not going to dictate that. Typically, your firm or your firm guidance or your firm policy will dictate how they calculate performance materiality. But again, it's just a certain percentage of your overall materiality. And your trivial threshold, again, is just derived from your materiality. So in our case, we're going to do it at 5% of materiality. So that's going to be 73,500. So this trivial threshold is super important because like we said during the presentation, this is going to determine can you completely skip over? What can you completely forget about? No matter if let's say you have an error or you have a reconciliation where you're tying your bank reconciliation to your trial balance and your difference is 69,000, you can say, hey, although I have a difference, it's immaterial. It's below my trivial threshold. The auditor will pass on further work. Let's say you have a difference or you have a total misstatement in a sample that you made, a non-statistical sample, or you extrapolated the error percentage to your overall population. If your error that you calculate, your total misstatement, your projected misstatement, and your total misstatement are below 73,500, you don't need to do anything. You can literally say, the auditor noted that the total misstatement from the error noted in our testing was 70,000. As this amount is below the trivial threshold, the auditor will pass on further work. And you're done. It's that simple. This is the most beautiful number in audit, your trivial threshold. Again, performance materiality is going to be a percentage below your overall materiality. And typically, you're going to base your testing on this number. So when you run a non-stat sample, when you run any sample at that, you're going to be using your performance materiality to run your sample. And materiality is, from a quantitative perspective, it's just going to determine what is important, what's not. If a number is below your materiality, you can typically scope that out, unless it has qualitative considerations that we need to consider, like liability sometimes are under your materiality, but the risk is always understatement. So I don't want to get too down that rabbit hole. That's more audit theory and a little bit more complex that we will get to in our audit series. But for the purpose of our presentation during this audit lecture is really just going over how to calculate materiality, the reasons why you would calculate materiality. The benchmark is one of the key factors of why you do, and just documenting the reason why you chose your relevant benchmark. And after that, it's just simple math and following your firm policy. So hopefully you found this helpful. If you found this helpful, please leave me a comment below if there's anything in this video that you want me to maybe cover a little bit more in detail. I really just enjoy doing these Loom videos because they're really easy to make for me because there's not a lot of editing on my part. I literally just do them in one shot. So yeah, if you guys got some value from it, please let me know. If there's any questions you have in particular, leave me a comment below. I'll see you guys in the next one.